If you're thinking about buying a rental property that actually cash flows in 2025, I get it. It feels harder than ever right now. Interest rates are still high, home prices haven't really dropped, and honestly, short-term rentals in Phoenix are oversaturated. But here's the thing, opportunity didn't disappear. It's just shifted. If you know how to buy the right property in the right part of the valley with the right setup and the right strategy, you can still generate consistent, reliable income without being glued to your phone managing guests every weekend. And that's what we're going to dive into today. I'm going to walk you step by step through how to buy a midterm rental in the Phoenix area that actually cash flows in 2025, even with higher interest rates and tighter margins. We'll talk about real numbers you should be looking at right now, which neighborhoods make sense and which ones don't, how to underwrite deals that still hit your return goals, and why managing yourself isn't the answer, but having the right management in place absolutely is. Whether you're a frustrated Airbnb owner or a brand new investor trying to figure out how to start this is your blueprint. As of 2025, mortgage rates are hovering in that 6.5% to 7% range. Inventory across Greater Phoenix is creeping up, but demand is still strong, under about 600,000. That means there are still solid investment opportunities out there. You just have to buy smarter. Gone are the days when you could pick up any listing, throw some furniture in it, and watch the bookings roll in. Right now, the short-term rental market, especially in Scottsdale, Tempe, and parts of Mesa, is flooded. AirDNA shows occupancy rates dipping below 50% in neighborhoods that used to sit at 75%. So where's the opportunity? Midterm rentals. 30 to 90-day furnished stays are the sweet spot for today's market. They attract travel nurses, corporate relocation, insurance placements, and families in transition. People who don't care about weekend getaways. They want comfortable homes for 2 or 3 months at a time. They're steady, professional, and far less hassle than weekend guests. Phoenix is built for this because of our hospital network, corporate relocations, and constant movement of people waiting on new builds or starting new jobs. That's why smart investors are pivoting towards midterm rentals right now. Before we get into how to buy one, let's get your mindset right. Buying a midterm rental that cash flows isn't about chasing the highest nightly rate or fanciest furniture package. It's about discipline and numbers. Cash flow in 2025 comes from making smart, data-driven choices, not emotional ones. If you've been in the Airbnb world, you're used to talking about potential gross income. Midterm investing is different. We're looking for predictability and consistency. That means choosing properties that are easy to furnish, easy to maintain, and located near major job centers and hospitals. If you can shift from vacation rental thinking to furnished housing business thinking, you'll win in this market. Not every suburb in Phoenix works for midterm rentals. You want to be close to hospitals, employers, or major highways that connect to them. Chandler and Gilbert are two of my favorites. They're perfect for travel nurses because of Dignity Health, Banner Gateway, and Mercy Gilbert. Homes here also attract relocating professionals and families between houses. Tempe works well too. It's close to ASU and central for both hospitals and downtown employers. Those mid-century homes and newer condos both rent beautifully midterm. Mesa is great for affordability. East Mesa near Banner Desert or the Tech Corridor is heating up for longer stays. South Scottsdale still performs for professionals on temporary assignments. You get the Scottsdale name without the Old Town party crowd. The key here is the proximity to demand drivers. You can't force location. You can upgrade design, systems, and furnishings, but you can't move a house closer to a hospital. Once you've nailed down your area, define your buy box. In 2025, the sweet spot is 400,000 to 600,000. That's where you can find single-family homes or townhomes in great neighborhoods that rent well furnished. Look for 2 to 4 bedrooms, 2 baths, minimum, safe and quiet neighborhoods, garage or covered parking, in-unit laundry, and some kind of outdoor space, a yard or a patio. Avoid HOAs that prohibit rentals under 6 months. Many East Valley HOAs are fine with 30-day leases, but always check before you go under contract. Function beats flash every time. You don't need a designer kitchen. You need comfortable, durable finishes that look clean on camera and feel good in person. Let's run through a real example so you can see how the numbers actually play out in today's market. Let's take a $500,000 home in Chandler as an example. You put 20% down, that's $100,000. Your loan is $400,000 at roughly 6.75%. Your principal, interest, taxes, and insurance come together and come out to about $3,100 a month. Now add your utilities, maybe $350, internet around $70, landscaping $100, routine maintenance about $100, and then management fees around 15% of gross rent. When you total up, you're all in at about roughly $3,800 a month. Now, here's where a lot of people get stuck. They look at that number and panic because a furnished midterm rental in Chandler rents for about $3,300 to $3,700 a month, depending on the size and location. So yes, on paper, you're slightly negative, maybe $200 to $500 a month. But this is where you have to start thinking like an investor, not a tenant. Because even though the cash flow line might show a small loss, that's not the full story. Every month, part of that mortgage payment goes towards paying down the loan. That's forced savings. You're also getting tax benefits from depreciation, typically around $8,000 to $10,000 a year in write-offs, which often offsets that small monthly shortfall. And here's the big picture. Rents will continue to rise and interest rates will eventually come down. When they do, your costs drop, but your rents hold steady, and that's where your property becomes cash flow positive. So right now, your goal isn't to hit huge monthly profits. Your goal is to own an asset that stays occupied, covers most of its expenses, and appreciates while someone else pays down the mortgage. That's why I say a property that even near break even today is still a strong investment in this market. You're building long-term wealth, not chasing short-term cash. I always tell my clients, stop thinking cash flow only and start thinking total return. When you add in equity, pay down, appreciation, and tax savings, your true annual return on investment can still land about 12 to 18%, even if you're not cash flow positive month to month. That's what stability means in 2025. Predictable occupancy, consistent tenants, and a property that's positioning you for long-term gain, not long-term stress. With a midterm rental, your tenant usually stays 1 to 3 months at a time. That means you might have 1 or 2 small gaps during the year, maybe a week or 2 in between guests while cleaning or new bookings roll in. That's completely normal. If your property rents for $3,500 a month and you're booked for about 10 to 11 months out of the year, you'll bring in roughly $38,000 to $40,000 annually. Yes, that might still leave a small shortfall compared to your total annual expenses, but it's predictable and easy to plan for. You're not sitting on a property that's empty half the year or relying on weekend bookings that swing wildly up and down like Airbnb. That's what I mean by steady. Midterm rentals give you reliable income and reliable tenants. You know who's coming, how long they're staying, and what you can expect financially. And because those stays are longer and more stable, you have less turnovers, less cleaning, fewer headaches, and your property remains in better condition. So even if you're not perfectly full year round, you're operating a predictable, low stress, income producing asset, one that positions you for future cash flow and appreciation. This is what smart investing looks like right now. And while you're waiting, someone else is paying down your mortgage every month. Unlike short-term rentals, you don't need perfect occupancy to make the math work. Even 85 to 90% keeps you steady. Now, let's talk about occupancy for a second because this is where investors often get confused. When I say 85 to 90% occupancy keeps you steady, what I really mean is that your income stays predictable, even if you're not 100% booked every single month. Now, let's talk financing because this is where a lot of investors miss out. Midterm rentals often qualify for the same conventional loans as long-term rentals, but you can also use DSCR loans, that's debt service coverage ratio, where the property qualifies based on its income, not on your personal income. And if you want to house hack, you can even use owner-occupied financing. Live there part-time, rent it midterm when you're not using it. DSCR loans are big right now because they give investors flexibility. Let's say your property rents for $3,400 a month. That can support the loan payment even if you personally don't meet W-2 criteria. Yes, rates are a bit high, but you can refinance later when rates drop and your rent holds steady. Before you buy, analyze the demand drivers because that's what fuels your occupancy. Phoenix has over 60 hospitals. Banner, Dignity, Honor Health, Abrazo, and travel nurse staffing keeps growing every year. Insurance placements are another big one. Every monsoon season and every fire season, families are displaced and need housing for 60 to 120 days. Insurance covers the rents, often above market. Corporate relocations are steady too. Intel, Wells Fargo, State Farm, Amazon, Lucid Motors, all bringing people in and out of the valley consistently. And don't forget seasonal residents, our snowbirds, who want flexible furnished options longer than 30 days, but don't want hotel pricing. All of that keeps the pipeline full for furnished rentals that are set up the right way. Now, let's talk about the mistakes I see buyers make when they try to buy a midterm rental. Number one, falling in love with the house instead of the numbers. This is not your forever home, it's an income property. If it doesn't pencil, walk away. Number two, forgetting startup costs, furniture, decor, linens, kitchen supplies, locks, smart home tech. Budget $8,000 to $12,000 depending on the size. Number three, buying in the wrong location. You don't have to be downtown, but you need to be within 15 minutes of a major hospital or employers. Number four, thinking you'll manage it yourself. You won't save money, you'll just lose time. Midterm rentals still need onboarding, tenant communication, cleanings, and vendor coordination. Number five, overestimating rent. Just because a comp lists at $3,800 doesn't mean it rents there consistently. Always compare to furnished 30 to 90 day rentals, not long-term or Airbnb listings. Avoid those and you're already ahead of most investors. If this kind of data-driven investing feels like what you've been missing, make sure you come back for part 2 of this series, where I'll show you exactly how to furnish, price, and manage a midterm rental that consistently performs and truly feels hands-off. And before you go, I want to mention something I created for investors who are serious about getting started the right way. It's called the Investor Starter Playbook. It's the exact guide I use with my clients to help them understand the numbers, evaluate deals, and set up a midterm rental for success. It's not a free download. It's a small investment of $27, but it can save you thousands in mistakes. Inside, you'll get the worksheets and formulas I personally use when analyzing real properties right here in Phoenix. If you're ready to take the next step and want a proven blueprint for buying and launching your own midterm rental, grab your copy using the link below. See you in part 2.